welcome back to the deep dive. If you're trying to quickly understand the true financial footing of InMode Ltd., the aesthetic and wellness leader, well, quarterly earnings calls can be a bit of a minefield. Lots of noise. Q3 2025 results are here, and we are going straight to the source. We're focusing exclusively on the financial picture painted by the CFO, Yarmelka.
Yeah, our mission today is really just to cut through all the sort of strategic talk and focus purely on the mechanics of the balance sheet based on what he said.
Right.
The central question we're exploring is InMode successfully navigating that inevitable transition, from a high-growth startup, sometimes reliant on big platform sales, to a stable, predictable global powerhouse.
Especially given this tricky year-over-year comparison and rising external costs.
Exactly. We're just isolating the core financial health indicators from his remark.
Okay, let's unpack this.
Yeah.
And we absolutely have to start with the headline revenue number because, without immediate context, it is deeply misleading.
It really is. So the top line revenue figure for Q3 2025, it came in at $93.2 million.
Now, if you just glance at the previous year, Q3 2024, you'd see revenue of $130.2 million. And that looks like, well, frankly, a catastrophic decline. A drop of nearly 29% year over year. That's a huge red flag, right? On the surface, at least.
And that's precisely why the context is so critical here. The CFO, he was very quick to remind everyone listening that the prior year's revenue, that high watermark of $130.2 million, well, it included a substantial sort of one-time influx.
Pre-orders.
Yeah, $31.9 million in pre-order sales. That massively skews the comparison.
So, okay, when we strip out that massive, unusual pre-order chunk, the core, the sustainable operating revenue is actually much closer to level than that initial comparison suggests.
Exactly.
That normalization, I think, is the key takeaway here. It shows the underlying business kind of stabilized rather than collapsed. It fundamentally changes how you view the Q3 2025 results.
It absolutely does. It shifts the whole discussion from panic about a sales decline to really analyzing the stability. Right.
And once we establish that stability in capital equipment sales, then we can turn to what's arguably the true engine of sustainable growth in this industry. Recurring revenue.
Yeah, and here's where it gets really interesting, I think, for the long-term health of the company. Let's talk about consumables and service revenues.
Right. Moving beyond just the initial sale of the machine, the razor, if you will, we look at the consumables, the blades. Consumables and service revenues reached $19.9 million this quarter.
And crucially, that recurring revenue stream represents a massive 26% increase year over year. I mean, that's not just small incremental growth.
Oh, no, it's significant.
That signifies a thriving installed base and presumably high platform utilization by their clients, right?
Yeah, exactly. And if we connect this to the bigger picture, the CFO actually gave us some insight into where that growth is coming from.
Oh, interesting.
He specified that the acceleration in consumables was driven primarily by markets outside of the U.S. Okay, that's strategically huge.
Yeah.
Because it demonstrates successful international penetration and maybe reduces their reliance on the more volatile U.S. capital equipment market.
That seems to be the story. And sticking with the product focus for a second, their core identity is still very much minimally invasive tech.
Yeah.
Those platforms accounted for a robust 75% of total revenues this quarter. So they haven't really diluted their high margin focus, which is important.
Good point. But that global diversification you mentioned seems to be the narrative driver here.
Yeah.
Let's look at the geographical split he provided.
Okay. Sales outside of the U.S. climbed slightly to $40 million. That now accounts for 43% of overall sales.
43%, wow.
And within that international segment, we saw a 10% increase year over year in sales.
Okay, so conversely, the United States still contributes the largest chunk of revenue, right? It hit $53.2 million.
It did. Still the biggest market.
But when you see the international segment growing at 10% year over year and driving that huge 26% consumables jump, you realize the global push is actually working.
It appears so. And just to give you a sense of the sheer scale supporting that push, the company apparently has 284 direct sales reps and distributors.
Wow.
Covering more than 73 countries. That sales infrastructure is massive. And, maintaining that level of scale must cost a fortune.
That is the perfect transition. Because maintaining that machine, that global footprint, and facing external pressures, well, that brings us directly to profitability. Let's pivot from revenue to the cost side of the equation. We saw a notable squeeze on gross margins this quarter.
We definitely did. The GAAP and non-GAAP gross margins in Q3, they were both reported at 78%.
Okay, 78%.
And, we always tend to look at non-GAAP because it strips out non-cash expenses like share-based compensation, gives you a much clearer view of the actual cash performance and operational efficiency.
Right.
But even that non-GAAP margin was down sharply from the 82% reported back in Q3 2024.
That 4-point drop is significant.
Yeah.
What specifically was the headwind there, did he say?
He was very clear and direct about it. The decrease was due to the anticipated impact of tariffs.
Tariffs. Okay.
This was apparently a cost increase they had already factored into their full-year outlook, and, well, they were forced to absorb it during the quarter. So importantly, this wasn't presented as an operational failure. It was a predicted external policy cost hitting them.
Okay, but let's pause here because 78% gross margin, I mean, that is still exceptional, right?
Whoa, absolutely.
In the medical capital equipment industry, a standard margin might be, 60%? Maybe 70% if you're lucky.
Yeah, somewhere in that range.
So holding nearly 80% while absorbing tariff impacts, that suggests they still have incredible pricing power and probably highly efficient manufacturing. That resilience is a strategic insight in itself, I think.
I agree. It's a very strong margin, even with the dip. But the margin contraction seems to have forced discipline elsewhere. We saw cost control in their operational spending, particularly sales and marketing.
That's fascinating. Sales and marketing expenses decreased to $44.9 million. That's down substantially from $51.9 million in the same period last year. So is reducing S&M a necessary belt-tightening measure, or is it potentially a bit short-sighted? Could it starve that international growth engine they claim they're prioritizing?
Well, that's a critical tension, isn't it? The CFO, he framed it as appropriate discipline. He directly attributed the cut to the normalized reduction in sales volume between the two periods. In other words, they were scaling back expenditures in line with a more stable, sort of non-pre-order boosted revenue base. That was the justification.
Got it. So when we look at overall operational costs, the efficiency story seems to continue.
Yes. GAAP operating expenses were $51.4 million. That's an 11% year-over-year decrease.
Okay.
And non-GAAP operating expenses showed a similar disciplined trend, came in at $49.1 million, which is a 10% decrease year-over-year. So they clearly succeeded in lowering the operational cost structure overall.
However, the combination of that lower gross margin because of the tariffs and the normalized revenue still resulted in significant pressure on the final operating margin.
Right. Absolutely. The GAAP operating margin ended up at 22%. That's down sharply from 37% in Q3 2024.
Oof.
And the non-GAAP margin dropped from 40% last year down to 25% this quarter.
Wow, that 15-point drop in GAAP operating margin, that means that for every dollar of revenue, significantly less is making it through to cover overheads and generate profit. That's the real sting, I guess, of the tariffs combined with that revenue normalization.
That's the impact, yeah. Which brings us directly to the bottom line figures. What did this all mean for net income and earnings per share?
Yeah, the actual profit.
So non-GAAP net income was $24.5 million. That's down significantly from the $54.9 million in the prior year.
Big drop.
Consequently, non-GAAP diluted earnings per share was $0.38 compared to $0.07 last year. Now again, this is largely the expected result when you remove a huge $31.9 million revenue event from the comparison period.
Right, the pre-orders again.
And then you compound that with the tariff pressure hitting the margins.
Yeah.
It's also worth noting share-based compensation, which gets stripped out for non-GAAP, also declined slightly to $2.7 million from $3.9 million.
Okay, so the earnings performance reflected those expected headwinds and the normalization of sales. Fair enough. But the true story of stability often lies not just in the quarterly income statement, but really in the financial foundation, the balance sheet. What does this all mean for their cash war chest?
Yeah, this is perhaps the most impressive and I think stabilizing nugget from the entire report he gave. The company concluded the quarter with a remarkably strong balance sheet.
How strong?
As of September 30, 2025, cash, cash equivalents, marketable securities, and deposits totaled, wait for it, $532.3 million.
Whoa, over $500 million in liquid assets.
Yeah.
That cash position is, what, nearly 6 times their normalized quarterly revenue, something like that?
Roughly, yeah. It's substantial.
That kind of liquidity just screams stability, doesn't it? But it also raises an important strategic question. What are they going to do with it? Are they positioning for a large M&A deal, maybe? Or is this simply capital preservation in these, uncertain global economic times?
Well, the CFO's remarks primarily suggested preservation and stability. That enormous cushion allows them to navigate these margin pressures, defend market share, potentially fund buybacks, all without needing external debt.
Right.
And they're still generating cash. InMode added $24.5 million in cash from operating activities during this quarter.
Impressive.
That ability to continually generate cash internally, even when revenues stabilize like this, really underpins their confidence moving forward.
And that confidence takes us directly to their outlook, their guidance. Despite absorbing the tariff costs and managing that tricky post-pre-order comparison, the company reaffirmed its full-year guidance.
Yes, they did, which signals management's belief that Q4 and the year-to-date performance will be strong enough to meet their prior forecasts.
So they see the margin pressures as manageable and the international growth as sticky.
That seems to be the message. They're holding firm on the outlook provided earlier.
Okay, so systematically, what are those key reaffirmed guidance figures you should be looking for?
All right. Management expects full-year revenues to land between $365 million and $375 million.
Okay.
The non-GAAP gross margin guidance remains between 78% to 80%. That indicates they anticipate the tariff pressure probably continuing, but maybe not worsening significantly.
Got it.
Non-GAAP income from operations is guided to remain between $93 million and $98 million.
Mm-hmm.
And finally, non-GAAP earnings per diluted share is reaffirmed to stay between $1.55 and $1.59 for the full year.
Okay, so what does this all mean for you, the listener? InMode's story for Q3 2025, at least based on the CFO's prepared remarks, is fundamentally one of, I'd say, successful transition and discipline. Wouldn't you agree?
I think so. They effectively managed the distortion caused by last year's big pre-order sales. They validated their international strategy, especially with that 26% recurring revenue growth outside the U.S.
Yeah.
And they maintained tight cost control on operating expenses, all while absorbing those anticipated tariff impacts that hit the gross margin.
Right.
And if we connect this to the bigger picture, that stability they possess, that $500 million cash reserve, it allows them to weather these kinds of external cost shocks like tariffs without necessarily jeopardizing their long-term growth projects.
Yeah, that makes sense. And the reiterated guidance is kind of the ultimate sign of confidence in their foundation, isn't it?
It certainly points that way.
Okay, and that leads us to our final thought for you today. Given that the CFO pointed directly to the tariff impact as the main driver for the gross margin decrease, what other external factors should you be watching? Like maybe shifting global trade policies, particularly involving major international markets like China or Europe? Could those next challenge a company relying so heavily now on strong international sales?
That's a great question. What should you look for in Q4 beyond just the raw numbers? That might signal either relief or maybe even greater pressure on those still exceptional but slightly lower gross margins. Something to think about.
Definitely something to keep an eye on. Thank you for joining us for this deep dive into InMode's Q3 financials, straight from the CFO's perspective.